This conference will now be recorded.
These are words of motivation.
Finds opportunity in everything. A negative mind finds fault in everything. Never stop learning because life never stops teaching. 6 rules of life. Before you pray, believe. Before you speak, listen. Before you spend, earn. Before you write, think. Before you quit, try. Before you die, live. 4 beautiful thoughts of life. Look back and get experience. Look forward and see hope. Look around and find reality. Look within and find yourself. The biggest suspense of life is that you don't know who is playing for you and who is playing with you. One who knows himself is never disturbed by what others think about him. Definition of a fool: knowing the truth, seeing the truth, still believing the lies. Yesterday is history, tomorrow is a mystery, and today is a gift. That's why we call it the present. Never argue with someone who believes their own lies. If you light a lamp for somebody, it will also brighten your path. No matter how poor you think you are, if you have a loving family, you have everything. You have 2 choices: to control your mind or let your mind control you. Don't believe everything you hear. There are always 3 sides to a story: yours, theirs, and the truth. Fake people gossip about everyone else. Real people mind their own business. Never judge people by their past. People learn, people change, people move on. What comes easy won't last. What lasts won't come easy. It is better to walk alone than with a crowd going in the wrong direction. Weak people revenge, strong people forgive, intelligent people ignore. Pain makes you stronger, fear makes you braver, heartbreak makes you wiser. So thank the past for better future. Everything happens for a reason. Don't question it. Trust it. Promise yourself to be so strong that nothing can disturb your peace of mind. Life is short, time is fast, no replay, no rewind. So enjoy every moment as it comes. Treat people the way you want to be treated. Talk to people the way you want to be talked to. Respect is earned, not given. Respect is like a mirror. The more you show it to other people, the more it will reflect back on you. A lot of problems in the world would disappear if we talk to each other instead of about each other. Don't carry your mistakes around with you. Instead, place them under your feet and use them as stepping stones. Never regret being a good person to the wrong people. Your behavior says everything about you. Their behavior says enough about them. Feed a dog for 3 days and he will remember your kindness for 3 years. Feed a human for 3 years and he will forget your kindness in 3 days. When you wish good for others, good things come back to you. This is the law of nature.
Well, how I got started in trading was came out of Syracuse, New York, and I became a chemical engineer.
Everything in your life is a reflection of a choice you have made. If you want a different result, make a different choice. You are strong when you know your weakness. You are beautiful when you appreciate your flaws. You are wise when you learn from your mistakes. Don't feel bad if people remember you only when they need you. Feel privileged that you are like a candle that comes to their mind when there is darkness. Satisfied life is better than successful life because our success is measured by others, but our satisfaction is measured by our own soul, mind, and heart. Nothing is permanent. Don't stress yourself too much because no matter how bad the situation is, it will change. Stop focusing on how stressed you are and remember how blessed you are. There are only 2 days in the year that nothing can be done. One is called yesterday and other is called tomorrow. Today is the right day to love, believe, do and mostly live. Life is the most difficult exam. Many people fail because they try to copy others, not realizing that everyone has a different question paper. What is stress? It is the gap between our expectation and reality. More the gap, more the stress. So expect nothing and accept everything.
Yes, thank you.
4 things you can't recover in life. A word after it is said, an opportunity after it is missed, the time after it is gone, trust after it is lost.
Welcome, my friends. Very important lessons of life. Right? Important things here are you have a power of choice between birth and death. There will be people who will be forgetting you, but they are not important. Life is like a train. When you get in, you enter with a new batch. And by the time you're out, there's another batch to say you goodbye. So don't take life very seriously. Have a balance, have a harmony. Tough times will come to teach you the lessons. Learn the lessons and learn to enjoy it. Welcome all of y'all. Hope you guys have done your revision. Great Rahul sir. Lovely. So let us start. Good. Let us start with what is volatility. First thing, what is historical volatility? It's a measure of dispersion of returns of a security or a market index over a given period of time. Virendra Sehwag batting, right? This is his average. How much has he scored more or less than the average? So there's a method. You calculate this through the method of standard deviation. How much more or less than the average has he scored? And this becomes the base of calculating historical volatility. Higher the historical volatility, the higher will be the difference from the average or the deviation from the average. Right? So there are 2 stocks, ITC, which is like the Cheteshwar Pujara, slow and steady, less volatile. Someone like Hardik Pandya, who is more volatile in his batting, which becomes an IndusInd Bank. So there is a huge movement compared to yesterday's close in IndusInd Bank. So more the volatile the stock, the better it is for an intraday trader. Right? Because it can give you more opportunities of a profit. Right? Historical volatility. So you remember the Excel sheet? We took out the historical volatility of Tata Steel, 2%. So For the upper end of the range, 600 if is the close, plus 2% is 612. Minus 2% is 588. So you get the upper band and the lower band, which is 1 standard deviation 68% of the times. Tata Steel is going to close in the next day between 612 and 588. Right? The same way you can take out the historical volatility for the year. How do I take it out? Manas sir, how do I take out the historical annualized volatility? What is the formula? What is the formula? Lovely. Daily volatility equals to annualized volatility divided by the square root of 256. Very good, Rahul sir. So 16 into daily volatility will be your annualized volatility. Are we all on the same page? 16 into daily volatility is equal to annualized volatility. Are we all on the same page? Are we all making sense? Good. So what is the distribution curve? So when I'm plotting the number of instances, the close is between the various bands. You saw we yesterday did band Nifty 0 to 0.25, 0.25 to 0.5, 0.5 to 0.75. When it is in the various bands, what do I notice? What do I notice? That near to the average, the number of instances are high. As we move away far from the average, the number of instances are reduced. So this is a normal standard distribution. What do you see? This is called the bell curve. Normal distribution, this is called the bell curve. Absolutely correct, Subrat sir. That was yesterday's example. Right? Every stock will have a different instance. Right? So, if I take the Tata Steel example, what was it? 600. 1 standard deviation, 612. 624, 2 standard deviation, 636. 588, 576, and 564. So very rarely when you see Tata Steel falling in the next day between 2 to 3 standard deviation. Very rarely when you see this. When do you see this? When do you see a 2 or a 3 standard deviation move? Who can tell me? Thank you, Rahul sir. Tata Steel results 4 times a year. That is the time you can see this big move. When a company results are declared, it generally gives a 2 to 3 standard deviation move. Right? When the company results are declared, 68%, 99, 95%, 99.5%. Outside the 3 standard deviation, you call the black swan event. Am I making sense? Good. Now, any question regarding historical volatility? Priyamando sir, after the revision, how are you finding? Are you feeling better? Good. To tell you honestly, when I started teaching all these things, I really found it very difficult. My answer, there is volatility. Now that strategy depends on how you are studying. Is there going to be a surprise or not before the company's result? If you think it is going to be a positive surprise, I will teach you what option strategies to make. If you think there's going to be a negative surprise, I will teach you what option strategies to make. Now, implied volatility is a matrix which is reflecting the market likelihood. What is the market likelihood of a given change in a securities price? Manas sir, you've asked $1 million question. There is no method to find out whether it is positive or negative. That is up to your thought process. So, anybody working in the IT field? No one? This is the first surprise I have seen. Yeah, Vijay sir. So, Vijay sir, if IT company is doing well, how do you come to know? If an IT company is doing well, how do you come to know? I answer 15 years in the market and you're telling me dollar. So what is the major raw material, Vijay sir, in IT? Manpower? Is it the manpower? So if Vijay sir, your company is going to give you, if your company is giving you a salary hike or a bonus, or if the company is employing more and more people, what is it telling you? Demand is more. I answer, it is manpower. So if you get to know the HR person of Infosys, human resource, the person will tell you that we require a lot of people. Why? Because there is a lot of work to be done. So for an IT company, it is a manpower, right? Do not worry, Manas sir. There is, if automation comes in, there are a lot of new other fields coming in. It's just not only automation. There are thousands of fields coming in. Right now, there is only automation in a few industries. There is scope to automate every industry. So don't worry, IT, there is huge demand, huge, right? So this is the way every sector you will come to know before the results. Like Infosys, buyback, they're going to do buyback worth 9,000 crores. There is a guy called Mr. Shivabul. He's one of the ex-owners of Infosys. Earlier, he was selling Infosys shares. Right now, he's buying the shares from the market. Earlier, he was selling. Now, he's buying. So that tells you the mindset that Infosys is still going to go up. Right? So Infosys results will be very, very good. Before the result comes in, I'm telling you it's going to be very, very good. Okay? So that's how you find out. There are certain thumb rules. So, absolutely, Meena ma'am, you've hidden the attrition rate. So it's a matrix which captures the market view of a likelihood change in a security price. Right? So future demand and supply. So I know Prime Minister is going to address the nation. What happens? The seller is asking for higher premium, therefore the IV goes up because of the uncertainty of the announcement from the Prime Minister. So IV is a leading indicator compared to historical volatility. So implied volatility is not the same as historical volatility. Why? Because implied volatility discounts the price of options. It is inside the price of options and it is the leading benchmark. We saw that when implied volatility went up, the price of options went up. When implied volatility fell, the price of options, both the call and put, fell. Right? Historical volatility will measure only from the past data what has been the volatility and will try to interpolate the past data into the current closing price. Okay. Now, whenever there is a high implied volatility, it means the market is expecting higher price movement either side. Whenever there is a low movement, the IVs will try to drop. So generally, if you see when there are no events in a particular time period, IVs generally drop. What are the major factors? Supply and demand are the major factors which influence implied volatility. So I've explained it to you that implied volatility increases in bearish market. Meena ma'am, it decreases when market is bullish. Can you tell me why does this happen? Why does the implied volatility go up? Why? So when the market is falling, what happens? Demand for put go up. So IVs of the puts are rising. Similarly, IVs of the call are also rising, but at a slower pace, right? And the VIX is going up. Why? Because everybody wants to hedge the portfolio against the fall. Because the falls are unstructured, they happen very quickly. Right? Similarly, when the markets are rising, there is no demand for puts. So the puts IVs are falling very quickly. The call IVs will also fall, but not as quickly as the put IV. And the overall VIX will also fall. So this is the way the market behaves in a rising and a falling market. So what are the times when the markets are also rising and the call and the put IVs are also rising? VIX is also going up. What are the times? Very good events. Very good. Company results. You see markets going up and the IVs are going up. Right? So IV is determined by the current price of option. It is represented as a percentage. It indicates the annualized expectation on a one standard deviation. So for example, IP of 25% on a 200 rupee stock would represent one standard deviation. Right? Yeah, earnings, Kuldeep sir, lovely. So basically you remember this, yesterday we did 200 rupee stock. Option chain, whatever IVs you're seeing, that is annualized. Right? So if 25% means 50 rupees in 200, so the upper band is 250 for the next 1 year. The lower band is 150. I answer. Is this clear? How did I take out the upper band and the lower band on the basis of IV? Bhavna ma'am, welcome. Where were you yesterday? I did not see you yesterday. Okay, you got fever. No problem. 200 plus 50 is 250. 200 minus 50 is 150. So answer, is it confusing now? Is it confusing now? Yesterday you felt confusing. Now do you think it's looking easy? I answered. Can you see what one revision can do? What one revision can do to your mind, to your confidence? Good. So what is one standard deviation? 68.2% of the outcome. Right? So in the next 1 year, 250 and 150, 68% of the times, it is going to remain there. If there's 2 standard deviation, what would be? If it is 2 standard deviation, what will the range be? 50 into 2, 100. So 300, that is plus 200 is the current price. That is 300 rupees. And 300, 200 minus 100 is 100. Am I making sense? 95% of the time it is going to remain this range. Right? This is statistics, plain statistics. Now you got to add price action to these statistics. Right? So the implied volatility, if it is 16% annualized, so the daily volatility will be the same formula. Daily volatility into square root of 256 is equal to annualized volatility. So the annualized volatility is 16. So the daily volatility will be 16 divided by square root of 256, that is 16, equals to 1. So if the stock closing yesterday was 150 rupees, so the upper band will be 150 plus 15, that is 165. 150 minus 15. 135. This is one standard deviation. Am I clear? Good. So what will be, Manas sir, what will be 2 standard deviation? It is 1%. Implied volatility is 16 annualized. So square root of 256 is 16. Manas sir, what will be 2 standard deviation? 150 plus 15 into 2. Lovely Manas sir, equals to 180. 150 minus 30. So Manas sir has passed his exam. Manas sir, please send me your Paytm number. I will send you a Cadbury. Oh, sorry, Meena ma'am has corrected me. 1.5, right. It is 1.5, not 150. So it is 1.5, right? So it will be 3 rupees. It will be 18 and 12. Fine. Meena ma'am, you got it right. Absolutely correct. 150, 1.5 and 148.5. Thank you, Meena ma'am. That's the advantage of having a maths teacher here. Advantage of having a maths teacher. Thank you. So let us not change this. So let us basically make this Meena ma'am 1500. So Meena ma'am, this will be fine. No, it will still not be fine. So let us make this 15 plus 1.5 is equal to 16.5. Thank you, Meena ma'am, for correcting us. 15 minus 1.5 is, oh sorry, I'm getting it all wrong today. 150 plus 1.5 is equal to 151.5, right? And 150 minus 1.5 is equal to 148.5. Thank you, Rimando sir. Thank you. Lovely. Am I all clear? Thank you. That's the advantage of having a maths teacher in your class. So what is Vega? Rate of change of option premium with regards to 1% change in IB. What will be your option premium if the IB goes up or down by 1% will be determined by Vega. So when IB goes up, Vega will increase the value of both the call and the put. When IB comes down, the option premium will be decreased by the Vega amount, both call and put. Right? So did we notice that whenever there is an event, there is an uncertainty like an election, IB goes up. What does the Vega impact? Option premium. So when option premium goes up, is it the intrinsic value or the time value? No, delta only influences the change in underlying. So it is only going to be time value premium. So IB does not impact the price of the underlying. So if Nifty goes up or falls, it is going to be impacted by the delta, not by the Vega. Vega is only the uncertainty component because of the IB increase. Am I clear? So in Vega, the time value premium increases, not the intrinsic value. Intrinsic value influence will only happen with the increase in delta. Am I making sense? Is this absolutely clear? Good. So when the call premium goes up, it is because of the increase in IB. It will be for all strikes, all expiries. Similarly for the put. So here when you see there is an increase in IB, both the call and the put premium will go up. Right? Any questions regarding Vega? So what is VIX? Meena ma'am. What is VIX? Which strikes are used in the calculation of VIX? Which expiry is used? Which instrument? One by one, which is the instrument? I answer which instrument? Which instrument? Nifty 50, thank you. Which expiry? Which expiry? Monthly expiry. Which strikes? Which strikes? Subrat sir, can you name the 5 strikes? Add the money. Call and put. Lovely Kavita ma'am, in the money. Out of the money. So 2 strikes in the money. 2 strikes out of the money. 1 strike at the money. So 5 strikes of call, 5 strikes of put. Average of these 10 strikes is the India VIX. After the 15th of the month, what will you do? Bhavna ma'am, after the 15th of the month, what will you do? You will take the current month, that is the June, as well as the next month, which is the July. Calculate these 10 strikes of call and put for the monthly expiry of June, monthly expiry of July, and the average of these 20 strikes will be the India VIX. Am I clear? Good. So what is the purpose of the VIX before I come? So what happens when the price goes up? Call will go up, put will decrease. When the price falls, call will come down, put will go up. So if you are taking in the money put, that same strike, call will be out of money. So call will have a lower premium, put will have a higher premium. Currently, if Nifty is at 15,700, if you take a 16,000 call and put, so 16,000 call, value is down. 16,000 put. In the money, higher premium, intrinsic value, higher value. When volatility goes up, call and put both will go up. Volatility falls. Time to expiry. Longer the duration, higher the premium. Lesser the duration, lower the premium. Right? Interest rates. When interest rate goes up, call option will go up, put option will come down. When interest rate falls, call option falls, put option premium goes up. So when a company declares a dividend, your call will fall by that amount, your put will rise up by that amount. So today, how is your Josh? Are you feeling it a lot better? How are you all of you all feeling? Yesterday was super tough. So how is today? Yeah, Kuldeep bhai, you will feel much better. The power of your mind. Yeah, Kavita ma'am, you're not well. Okay. Good. Super tough to better. Wow. Okay, now what is the purpose? Shahid ma'am, what is the purpose of IV? Why are we talking about this IV? Is there any need? Manas sir, we all know that we cannot compare the option premium because of the theta component. We cannot compare the option premium because of the theta component. But we can compare the IVs with the past IVs to know whether the current IV is expensive or cheaper than the past IVs. If the current IV is expensive, how do we know that? There are two processes. One is called the IV rank, where I subtract the current IV from the 52-week low divided by 52-week high less 52-week low into 100. Right? 52-week high minus 52-week low divided into 100. So we saw yesterday that when we were doing this process, that the IV high of Nifty was 90, 89, 90, only for 5 days. Then it fell below 60. And the IV low was 10, only for 5 days. Then it was above 50. So they were catching the outliners. So this 88 to 60 was only for 5 days. 10 and 15 was only for 5 days. So this process is not very suitable. So what else can be the suitable process? IB percentile. Number of days over the past 1 year that your IV, current IV is greater than the past IV is called the IB percentile. So what does the number suggest? If it is between 0 and 20, that means if your current IV compared to the past IV is between 0 and 20, which is it currently is, that means options are cheap. You can buy naked options. If the IV's current IV percentile is 20 to 40, it is relatively cheap. You can buy option strategies. If it is between 40 and 60, it is neutral. You can do both buying and selling strategies. 60 and 80, moderately expensive. Only selling strategies. Between 80 and 100, very expensive. Only selling. Right? So now I come to know, only thing I need to avoid is the event. If the event is there, IVs will tend to be higher. So I can't just be selling before an event, because I know that if I sell before an event, I might be trapped. Right? I might be trapped. Am I making sense? Good. So are we all set? So I showed you where you have to check the IV percentile. I don't need to check the IV. I need to check the IV percentile. Right? So before making a strategy. Correct. Right. Good. So now, let's get going. Let's start the strategies. I think so. This is going to be. So friends, congratulations. The most difficult part of options is over. From here, things are going to be relatively easier. Not required, I answer. Not required. When I can get the wholesale, when you can get ready-made food, why to make? So let us start the strategies. So now we need all the experienced people who are good technical analysts who help us to find out the trend and the direction. Why? We are coming here. Never give up. Today is hard. Tomorrow will be worse. But day after tomorrow will be sunshine. So there are people's life, if you see that there will be tough times. Everybody has to go through it. And you've got to fight out. There is no other way. Because these are the lessons which life wants to teach us. Right? So always believe that there will be sunshine and learn to fight. Now, when one or more legs of all our foot are used, so we have already taken long straddle, long strangle, short straddle, short strangle. So you've already been influenced to the world of strategies, right? You've already been influenced to the world of strategies. So where are the strategies used for? Directional trend. That direction means you know that the market is bullish. You know that the market is bearish, right? That is called directional. You know, either through the help of technicals or through the help of fundamentals or through the help of sentiments, you know the direction of the market. Point number 2, non-directional market. I don't know the direction, but I am betting a big move, which we have already done, long straddle, long strangle. or I'm betting on a range bound movement either side, short straddle, short strangle, right? Very good. Now the first one, directional strategy, bullish, bull call spread. So can you see the word bull? Can you see call? What is the meaning of the word spread? I'm buying one call and I'm selling another call. Difference between two calls is called a spread. Difference between two calls is called a spread, right? So how do I execute it? So my friend Kuldeep sir, he is very bullish on Nifty. So I don't know how do y'all see the chart. I'm showing you one style which I see the chart. So this is the chart trading view. Let us put Nifty. I'm not a very good technical analyst, so I can't guide you too much into it. But I can just show you this is the closing basis chart of Nifty. I have put in a 50 moving average Bollinger Band with a 0.7 deviation. So can you see when the market is going up, it stays above the upper Bollinger. When the market is going down, it stays below the lower Bollinger. Yes. So can I find a direction with the help of a Bollinger Band? And when it is inside the Bollinger Band, that means it's in a range. So my simple principle is for 3 continuous days, if the market stays above the upper Bollinger, the trend is up. What is it? The trend is up. For 3 continuous days, if the market stays below the lower Bollinger, the trend is down. Right? Now, if the market from the lower Bollinger for 3 days stays inside the middle Bollinger, the trend becomes neutral. Right? Trend becomes neutral. So what am I seeing? Where are we currently? Are we in an uptrend? 3 days, is it above the Bollinger, upper Bollinger? Right? So currently we are in an uptrend. Right? Now, where can there be a problem? So if I see here in most of these charts, whenever on a closing basis, if there is some base and the market goes down, this is where the problem comes in. So if I see here, can you see here? This is where the closing basis Bollinger is. So if Nifty falls, what is this close? 15,635. If Nifty closes below 15,635, these are all closing charts. If Nifty closes below 15,635, then the first problem, so Bhavna Bam was asking me about the chart. Till now, if Nifty survives above 15,635, please don't panic. There is nothing to panic. But if Nifty, the day Nifty closes below 15,635, then you are in some trouble. Still the trend will remain up. but there could be some profit booking coming in. So if you are surviving 15,635, Bhavna ma'am, I think so it's a good buying area if you are surviving. So tomorrow is going to be a very critical day. Very critical day. Right? Because if I'm seeing this chart, it is taking away all the volatility. Now if I see a candle, can you see? It really went down yesterday and came up. So can you see this 15,635? Can you see when you see this candle, it fools you quite a bit. So if you want to see the bigger picture, you get to see this. Now, how many of you have heard momentum trading? Anyone? Okay. So this ROC is a momentum indicator. Buy higher, sell highest. ऊंचा ऊंचा खरीदना है, उसके ऊपर ऊपर बेचना है. That is called momentum. So if I see here, if you see here, so whenever there is a sharp jump in momentum, it is assumed that the smart money gets in. Whenever in 5 days if Nifty goes above 3%,
किस कंपनी
that's the smart money.
कंपनी का बजाज से ही चलता है ना पंखा.
क्यों पंखे किस किस के आते हैं यार अच्छे
Right? So whenever there is a sharp increase in momentum, or whenever this 5-day ROC goes above 3%, what do you see? That some smart money is getting in. Can you see here? This is that first spike. See here. So whenever you see this ROC, it actually gives you the momentum. Can you see Nifty on a closing basis? There is hardly any momentum in the fall. Can you see this? There is no momentum. So when the market is correcting without any momentum, can you see here it fell with momentum? But it was, the trend was not down. Again, the pullback was also severe. Right? So what do people do? So there are some algos. What do they do? If this is above, this is in a buy. Moment the 5 ROC goes above 3, they buy on closing. They buy on closing and they will exit when it goes to 0. So can you see they are riding, and this is where they've exited. So they got in here above 3% at 11,384. They kept on riding for the next few days, and they exited here at 12,800, 1,500 points. So this is called momentum trading. You buy when that first flush of institution buying is seen and the trend is up, and you will exit when the 5-day ROC goes below 0. So I don't know whether you've heard about these words: momentum buying, trend following. Right? So these are those terms. So I think so Kavita ma'am can take a class. She's been doing technical since 25 years. So these are simple ways to catch a trend. Right? So now if I don't want to buy futures above 3%, I don't want to buy futures. What will I do? I can use option strategies. Right? I can use option strategies. How do I do it? So did you understand when the 5 ROC probably goes above 3% and Nifty is in an uptrend, I will make an entry in the bullish side. And when will I exit? I'm showing you when it goes below 0 here. Right? Great. So Kuldeep bhai, I've shared a very big secret. Probably I should take a technical class soon. Right? So buy one call. So Kuldeep bhai is bullish. And I said these are all free sites. Why are you? I answer why do you get so hassled so easily, sir? These are all free sites. I have not paid anything for subscription leaving iCharts. Okay. So I am buying. Kuldeep sir is bullish, so he's buying 15,800 call. Jayavanti ma'am, what is the drawback of buying a call? What is the drawback? What is the drawback of buying a call? What is the drawback? Can you see the Greeks? Can you see the Greeks? The delta is 0.38. It's fine. Can you see the theta? Minus 11.6. So even if Nifty opens at the same price, I will lose 30 rupees. Theta loss. So very dangerous. My probability of making money reduces. Right? So what does Sunil sir do? He goes to the option chain. He goes to the option chain. And in the option chain, Kuldeep sir goes and checks out. And he sees that 15,800, 15,900 all have high open interest. So he believes that 15,900 is the recent high of Nifty. He checks out the recent high is 15,900. Right? So what he does, he sells 15,900 call. So what he's done, he's done one strategy. He has bought one call, higher premium. He's selling a call of a lower premium, 31 rupees. So what has he done? He has bought one 15,800 call. He has sold one 15,900 call. So when I combine this two, what is it? Till 15,800 his loss is limited. 15,900 his profit will be maximum at 15,900 and above. How? So when you are selling a call, you are receiving the premium. So what is the net outgo? 33 rupees. Yes. Now, my friends, what is the advantage? Earlier, he was paying, Kuldeep sir was paying 64. Now, since he sold the call, he received 31 rupees. So from 64 minus 31, his net investment from 64 has come down to 33 rupees. Now, if you see one thing, What has happened? Can you see his theta loss, which was 11? Since he has sold a call, we all remember, writer of a call gets the theta benefit. So now he receives 9 rupees theta benefit. What is his overall theta loss now? 2.7 rupees. So from 11 rupees, Kuldeep Bhai, with the help of the strategy, has brought down his theta loss to a manageable 2.7. So what is the spread difference between 15,800 strikes and 15,900? One strike you are buying, one strike you are selling is called a spread. So this is bullish. So you're bullish, you're buying calls. You're buying calls, you are bullish. Now, how is it done? Can you see the delta? Delta is also neutralized. So earlier you were getting 0.38 delta, now you're losing, but still your delta positive, 0.5. See, the gamma is also neutralized. So when you do a strategy which is a bull call spread, all your Greeks are neutralized. It's not that you're only getting advantage in theta. You have to give up your advantage in delta also. But we are comfortable. Why? Because I know now my maximum payoff is 100 rupees. So my risk is 33. My reward will be 67. So my risk reward ratio is in my favor. 33 into 75, 67 into 75. Right? So my risk reward ratio is in my favor. So the gamma neutralize, vega also neutralize. So what do you see the Greeks in a bull call spread? Delta plus, theta minus, gamma plus, vega plus. Is this making sense? So now how will the chart look like? So this is the 15,800 call. And this was your 15,900 call. Yeah, you can use this in monthly also. This is your actual graph. So your unlimited profit from the 15,800 call neutralizes the loss of the 15,900 call. So your net chart will look limited profit above 15,000. Break even point will be 15,800 plus 33, 15,833. And limited loss. Bhavna ma'am, sir felt in the option chain that Nifty. Can you see the chart also? The highest level was 15,000. What was the level? 870. So 15,900 is a strong resistance. 15,900 is a strong resistance. Right? And what is the support? Lower, 15,550, 600. So what is he doing? He's selling the call to collect or generate some theta advantage. And he believes there is a resistance matching with the option chain. So now let me go down. Let us see the chart, P of chart. Can you see below 15,800? His loss is fixed, 33 rupees. Break even point 15,833. Above that, very big profits. Above that, very big profits. And the profit freezes, as I told you. Limited profit, limited loss. Now, can you tell me one big advantage of this strategy? Can you tell me one big advantage? Can you see the margin here? Lowest margin. Only 23,000 rupees, one lot. So if I'm buying one call and selling a call, all my negative impact of theta gets neutralized. Can you see this? So if you did not know Greeks, you wouldn't have understood the importance of this strategy. Your cost is coming down and your margins are the lowest. So those people with 1 lakh rupees capital also today have a strong chance in surviving this market. Yes, so what you will do when you are buying, you have to buy this first, sell this. When you are selling, you have to sell this first, so you have to buy this and then sell. So always this is first, this is last. This is second, this is third, this is fourth. Is this clear? So when you're buying, you will buy the call first, higher premiums, then sell this call. When you're squaring off, you will square off the sold call first and then buy this. Right? So what it does, it improves your chances because of this theta impact. So let us do the theory. That is why I keep telling you revision is very important now when you come to strategies. So I've taught you, find the momentum, find the trend, enter into a bull call spread. I did this in Tata Steel. I'll just show you the Tata Steel chart. It was showing a breakout in open interest. I'm coming, sir, when I got to use this. See Tata Steel. Okay, can you see here? This was this level when this broke out, 800 rupees. If you see the open interest, there was a breakout in the open interest. I had bought the 820 call. I sold the 880 call here. Can you see? It went up to 918. And I exited here somewhere around 880. Right? So this momentum indicator ROC, when the price is moving up, gives you good entries. You can wait for a small correction also. So I've taught you a lot of things. Let us revise. I taught you future open interest on the first day. I taught you option chain on the second day. How to see the option chain and take out which levels will act as resistance. Now, after that, I taught you short straddle and strangles, which was with the Greeks. Then I taught you about option premium, which are expensive or cheap with the help of implied volatility and IV percentile. And today I'm teaching you how to play direction with the help of options. Limited risk and very good risk reward ratio. So Kavita ma'am will take a class, last class, and will teach her all her technical strategies. And then I will teach you what strategies to use with her option style. I will use her technical insight. Sir, I will keep buying. राहुल भाई मैं घुसा रहूंगा जब तक मेरे को अच्छा प्रॉफिट नहीं आ रहा है या आरओसी माइनस में नहीं चला जा रहा. So technically after 851 I will exit. Now again I will get in at 894. And if you see this trade, this was a beautiful trade. From 890 it gave me an exit at 1150. Right? 890 it gave me an exit at 1150. So I've taught you, now you have to build it, right? अगर सब चीज मेरे से सीखेंगे फिर टेक्निकल क्लास लेना होगा, अपने को ऑप्शन क्लास बंद करके we'll have to start with a technical class. So what are you doing? Always remember +1 minus 1. Higher premium, lower premium. Plus 1, higher premium, minus 1, lower premium. I am buying a call with a higher premium. It can be in the money, at the money, but it has to be higher premium. I might be at the money, out of the money. It has to be lower premium than the first leg. All strikes belong to the same underlying, to the same expiry, same number of options. That is why the name bull, call, spread. Spread is buying one strike, selling a similar strike. Difference of the two strikes is called a spread. Two similar contracts difference is called a spread in financial terms. Right? Am I clear with it? Good. So bull call spread is taken when you are bullish about the market. If you are not bullish, you will not take a bull call spread. The leg 2, this was a question Bhavna ma'am asked. Is that out of money strike where there is highest open interest? That is why we sold 15,900. There was high open interest in Nifty along with the technical resistance in the chart where the market players are expected profit booking. So right now, whether you like it or not, Nifty has a very strong resistance at 15,900 and not 16,000. Right? I would say that Nifty has a very strong resistance at 15,900 and not 16,000. That 16,000 is gone. Right? So how does it happen? You're buying the call. $15,800. You're selling a call. 15,900. So now I believe all of you all can draw this call by hand. So when you're buying a call, this is profit, loss, limited loss, unlimited profit when the market goes up. When you're selling a call, limited profit, unlimited loss when the market goes up. Is this clear? So when I combine this 15,800 here, actually this is the graph and this is 15,900. And if I see the 15,900 graph, it is something like this. So this unlimited loss of this 15,900 and unlimited of profit of 15,800 call, it gets neutralized. So when it gets neutralized, you get this limited loss, 1,500 and below, limited profit, which is the maximum profit start from 15,900 and above. Am I clear with this? So now let us do this whole thing in Excel. There is no backtesting software, Kuldeep sir. Which software you are talking about? राहुल सर, जब आपको लग रहा है कि मार्केट गिरेगा, or you feel that now the market is not going to be up. Kuldeep sir, let's not discuss out of the context webinar stuffs. Manas sir, always remember, whenever you are trading directional, whether you are doing a spread, there has to be a stop loss of Nifty. So Kuldeep sir, if he is bullish in the market, Kuldeep sir might have a stop loss that if it closes below 15,600 or if it goes below 15,500, Kuldeep sir will square off the position. Always you must have a stop loss. In a directional strategy, even though this is a limited loss, always a stop loss. Why? Because there is a reason why you are bullish. So if that levels are breached, then there is no question of keeping that trades. Okay, so now let us do this in an Excel. What did we do? Kuldeep sir bought 15,800 call. He sold 15,900 calls, 75 quantity minus 75. What rate did he buy? 64. And he sold 31. So what is his net investment? 33 rupees. Okay. Now what will be the price of Nifty during expiry? Kavita ma'am, please listen carefully. We are taking the various probabilities. Yeah, the next example will be with Bank Nifty little later on. Kavita ma'am, please be with me. Now if Nifty closes at 15,400, what will be the on expiry? This is on expiry. If Nifty closes at 15,400 on expiry, what will be the value of 15,800 call? What will be the value of this 15,800 call? If Nifty closes at 15,400 on 24 June, will it be zero? Yes or no? Zero? What will be the value, Kuldeep sir, if it is not zero? So you are buying a call 15,800. Daam Nifty ka 15,400 hai. So is this in the money, at the money, or out of the money? Thank you, I answered. You have understood. So if it is out of money, no intrinsic value premium. It will be zero. 15,900, Kavita ma'am, is this zero? If Nifty closes at 15,400, will it be zero? Some are saying no, some are saying yes. What was the formula? Intrinsic value. What is in the money option? Spot greater than strike. What is the strike? 15,800. What is the spot? 15,400. Is the spot greater? Is the spot? So then it is out of money. So will it be zero? Right? So if both closes at zero, we don't receive anything. What is the loss? Premium loss. So what is the total loss? The premium invested. Am I making sense? Yes, Kavita ma'am. Am I now making sense? I knew you were confused. That is why I take this example. Only for you. Before the revision, I knew you were confused. Now it comes to 15,500. Strike greater than spot. What is it? What will it? The 15,800 call. Zero. Yeah, Nilesh sir. What is the formula for in the money? Nilesh sir, आपने 15,800 का कॉल खरीदा. निफ्टी 24 जून को 15,500 में बंद हो रहा है. आपने 15,800 का कॉल खरीदा. निफ्टी 24 जून को 15,500 में बंद हो रहा है. आपको एज ए बायर कुछ पैसा मिलेगा? 15,500 में बंद हो रहा है. कैन यू सी दिस प्राइस हियर? आपने 15,800 का कॉल खरीदा है. You have purchased. Kuldeep sir has purchased 15,800 call. Nifty closes at 15,500. What will be the value of this call? Zero. Okay. तो ये दोनों जीरो होगा क्योंकि ये भी आउट ऑफ मनी है. तो कुलदीप सर को कोई लॉस नहीं लगेगा. जीरो रहा. नेट में क्या नुकसान हुआ? ओनली द प्रीमियम. 15,600. What will be the 15,800 call? Zero. 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 So can you see the loss is only limited to the premium paid? Now let's come to 15,700. Lovely. Bhavna ma'am has become an expert. 15,800. Add the money. What will it be? Add the money. Kya hoga? Zero. Lovely, I answer. Today you've been a champion. Wow. That's why I told you, when the strategy comes, you will be a champion. Now, what will happen? 15,900. Nifty closes at 15,900. What will be the value of the 15,800 call? Yes, I answer is saying 100. Kavita ma'am, 100. Strike greater than spot. So what is the strike? Spot greater than strike. 15,900 minus 15,800. Kuldeep sir, what is the spot price? 15,900. What is the spot? 15,800. So 100 rupees. This is the call. What will be 15,900? Zero. Why? Because Nifty is same price as the spot. Zero. So now I'm making 100 rupees. How much I have to pay as premium? 33. What is my profit? 66. Sorry, 67. See, I'm so poor in maths. Now 16,000. $200. Kuldeep sir, is this clear? If you have got 15,800 call and Nifty closes at 16,000, 200 rupees you will receive. Why? Because you have bought a call 50. Nilesh bhai, is this clear? Now comes the interesting part. Nilesh bhai, Kuldeep bhai ने 15,900 का कॉल बेचा है. Put नहीं है, कॉल है. What is the price of Nifty? 16,000. Spot minus strike 100. Lovely, I answer. I answer gets a party. Why it is minus 100, not plus 100? Why? Because Kuldeep sir has sold this call, so he has to pay for it. So it will be minus 100. Why? Because he has sold this call. He has to pay for it. So the net 100 rupees. What is the premium? 33.67. Now 16,100. Manasda 15,800 call. What will it be? 300 rupees. Lovely Satish sir. 15,900 he has sold. How much will he have to pay? Minus 200. Lovely. So can you see this profit is stable at 67 rupees. Can you see what is the break even? 15,800 plus the premium. So break even is 15,833. My loss is fixed. So when I draw this, my maximum loss 33 rupees from 15,800 to 15,900. So like this. Is this strategy clear now? Kavita ma'am, have I passed your exam? Good. Nilesh bhai, is this clear? Single break-even point. Yes, I answer. Single break-even point. Good. So this you will do when you are bullish in the market. You will buy a call, you will sell a call. Different strike, higher premium call you are buying, you are selling a call of a lower premium. Am I clear now? You will always calculate the first call plus the premium paid. First call plus the premium paid, that is 15,800 plus 33. This is your break even, right? Always you remember, when you're buying the call plus premium is your break even point. When you're buying a put, कुलदीप भाई महाभारत खत्म हो गया, उसके बाद आप बोल रहे दोनों कॉल था, दोनों कॉल ही था स्टार्टिंग में, बुल कॉल स्प्रेड, bull call spread. I'm bullish, both are calls. Good. Okay. Please click this photograph. Bhavna ma'am, Kuldeep bhai was bullish. Okay. So he was expecting that Nifty will at least go to 15,900. Right? 15,900. Okay. So he bought the 15,800 call, sold the 15,900 call. Why did he sell this, Bhavna ma'am? Option chain, high open interest, chart. Market has given a 200-point fall from there. 4 days to expiry. He does not expect Nifty to go up more than 200 points. So you will make your decision with the help of chart, with the option chain, future open interest, global markets, and you will decide on your stop loss there. Am I clear? Option does not tell you where to buy and where to sell. Option will only tell you how to play the market according to your view. So that view you can learn through technical analysis, you can learn through fundamentals, you can have your own setup. So Bhavna ma'am, this strategy you don't need to check theta. Why? Can you see this? Theta will always be negative, delta will always be positive, gamma will always be positive, vega will always be positive. Right? Okay. I have given you one strategy, I answered. You are already a master in technical analysis, doing it since the last 10 years. I think so. I don't think so I need to guide you on technical. Please click a photograph. Please click a photograph, send in the WhatsApp group. Right? Please click a photograph, send in the WhatsApp group. Have you sent it? Good. Both the photographs? Good. No, margin not required. Good enough. Now we come down. Both the photographs have been sent. Good. Bull put spread. Now the second strategy. This is what Kuldeep sir had sent us that day. Bull put spread is a strategy where you use two legs. So can you see? You are bullish. You're using put, and spread is the difference between the two strikes. So how can you be bullish with the help of puts? How can you be bullish with the help of puts? Who can tell me? Rahul bhai, salute you today. Rahul bhai, salute you. Today you are a true champion. Sorry for disturbing you yesterday. But today your revision has been near perfect. Near perfect. Your confidence is sky high. Right? Good. 5 minutes, Bhavna ma'am. We will take a break. We will complete the strategy and take a break. Right? The difference between a bull call spread and a bull put spread is Bull call is net debit. You saw this? We were paying premium from our pocket. 33 rupees. 64 minus 31. Now in a bull put spread, you will receive a net credit. Why? You are selling a put -1, higher premium. You are buying a put +1, lower premium. -1, higher premium. +1, lower premium. All strikes belonging to the same underlying, same expiry, same number of options. -1, higher premium, +1, lower premium. So let us take this example. Currently, same example of Nifty. Instead of selling the 15,800 put, buying the 15,800 put, a call, Bhavna ma'am is making a bull put spread. She has sold the 15,800 put and she has bought the 15,900 put. Sorry, she has sold the 15,900 put and she has bought the 15,800 put. Okay, -1, +1. So when you are selling a put, 202 rupees, she is receiving 202. How much is she paying? 134. So what is the net credit she is receiving? +202 minus 134. 68 rupees. Right? 68. Am I correct? Now please understand. Yeah, let's check the margin. 31,000 rupees only. Now let us draw this PL. 15,400, 15,500, 15,600, 15,700, 15,800, 15,900, 16,000 and 16,100. Yes. So what happens? Sir, don't think about three lots. We will do only with one lot. So what happens? You have bought a 15,800 put. Market is falling. So for the put in the money, what is it? Spot greater than strike. Remember? So you have bought a put 15,800 and the price is down. In the money 400. Lovely Manasda. You have sold a put in the money. Price is down. Now, since I have sold, what do I have to do? Just think again. Just think, if you had bought 15,900 put and Nifty closes at 15,400, what would happen? Reminder, sir. If you had bought, you had to pay 500. You would receive 500. Since you have sold, you have to pay 500. Right? Think again. I'm a seller. I have sold 15,900 put. Nifty closes, right? 15,400. So this put has become in the money. Market is falling. So 500. Am I clear with this? Minus 500. So what is my net payoff? Minus 100. How much did I receive? 68. How much is my loss? 32 rupees. Now 15,500. What is it? 300. Lovely. Meena ma'am, being a maths teacher, is very quick. Minus 32. Riamando sir, can you see my loss? Kuldeep sir, can you see? Even if the market is falling, right? Bhavna ma'am, just revise. Seller of a put. So when you have sold a put and the market goes down, you have to pay unlimited loss. So what is the formula? Strike minus spot. So strike is 15,900, spot is 15,500, 400 rupees. Since I've sold, I have to pay. Strike minus, I've sold this, right to sell. Right? Put is what? Right to sell. So if I'm a buyer of a put, I'm receiving 400. If I'm a seller of a put, I have to pay 400. So you got confused between the buyer and the seller. Okay? Just correct it. So if I was a buyer, I would have received 400. If I'm a seller, I have to pay this. 15,600. If I'm a buyer of a put, 15,800. Nifty closes at 15,600, 200. This, if I am a buyer of a put, 15,900, 15,600, 300, receive. I'm a seller, I have to pay. Minus 100 is the loss. 68 is the net premium received. My loss is minus 32. 15,700. What will it be? 100. Lovely. Minus 200. Minus 100. 68. Minus 32. Right? 15,800. 0. What will this be? Minus 100. Minus 100 is the net. 68 received. Minus 32. 15,900. 0. 0. 0. 68 profit. So whatever the premium I receive, 16,000, 0, 0, 0, 68. Am I making sense? Can you see this? Now, my friends, kindly go and check your WhatsApp. Can you see the peer? Is it the same when I did a bull call spread? Is it very similar? Can you see the Greeks? They are practically the same. So my friends, if you are doing a bull call spread or a bull put spread with the same strikes, this was a bull call spread. And if you are doing a bull put spread, same strikes, your Greeks and your profitability will be nearly the same. Hardly any difference, Rahul sir, 5,000-10,000 rupees different. So I can do a bull call spread or a bull put spread. Bull call spread or a bull put spread. If I do with the same strikes, it will give me the same results. Right? Bull call is better. Bull call is better. Less margin, same results. Less margin, same results. Am I making sense? So can you see this? The PL is the same, the profit and loss is the same. Can you see the break-even point is also the same? Can you see this? 15,832. Can you see here my loss is 32 rupees here, and from here I've got into profits. So if I see the graph, just see the payoff graph, it's the same. Can you see this? Very easy. Can you see the Greeks? So what are the Greeks? Delta positive. What are the Greeks? Delta positive, theta negative, gamma positive, vega positive. So if the market goes up, it will benefit me. If the market comes down, I will be a loser. Am I clear? Good. So if I've told you to do a bull call spread, Manasta, when will you do a bull put spread? If I've told you you should not do a bull call spread, when will you do a bull put spread? When? If I'm suggesting bull call spread, and most of the times, when will you do a bull put spread? Take a 10 minutes break. Take a 10 minutes break. Come back. Right? So it is 5:42. Come back by 5:52. Here is your margin, 31,000. Here is your margin. So when you will do, Kuldeep bhai, come back 10 minutes. We will discuss. Welcome back. How's it going? Nilesh bhai, how is it going? Mukesh bhai, Kavita ma'am. Can you hear me? Can you see my screen? Good. Nilesh bhai had asked a question, ki sir, for selling the margin is more than 90,000. Nilesh bhai, there have been new SEBI rules which have come that for trades where your loss are defined, SEBI has reduced the margin. So for trades like bull call spread, bull put spread, where my losses are covered, I don't have to pay the full margin. I get the margin benefit. So these are something nothing. These are your two puts taken together, and the payoff diagram is for the 24th of this June expiry. The payoff diagram is for 24th of June expiry. Now the question which comes to my mind, right? The question which comes to my mind, when can I use a bull put spread? When? Okay. Did I teach you something like when IV percentile are greater than 65 or 70? Did I teach you something? So when the IV percentile is greater than 65, 70, what is it? Option premium will be expensive, right? Will the option premium be expensive? Right. Now Bhavna ma'am has seen the Nifty chart. She feels that Nifty has a strong support at 15,500. So what has she done? 1st July, she has sold the 15,500 put. Right? She has sold the 15,500 put, which is out of money. Why? Because let us assume that these premiums are more. Let us assume that the IB percentile is 66, right? So she has sold 15,500 put. So if the IB percentile would be 66, let us assume my answer, then this IB would be something around 17, 18, right? This IB would have been something around 17 or 18. So this premium would be somewhere around 95 rupees. This premium would have been something around 95 rupees. Since the IB is low, we are not doing it. But if the IB percentile goes to 65, I will sell an out of money put where I feel there is a strong support. And in order to protect against unlimited loss, what will I do? I will buy a far out of money put. I will buy a far out of money put. Right? Whenever the IV percentile is greater then 65. What will I do? I find the support at 15,500. I will do a bull put spread 15,500, 15,300 minus 75 plus 75. Current price of Nifty is 15,700. So what am I doing? I'm selling the 15,500 put, buying the 15,300 put. Why am I doing here? See the Greeks. Delta positive. Can you see the theta? Can you see the theta? So when I'm using out of money strikes, yeah, in all the cases you will first buy far out of money and then sell out of money. So Bhavna ma'am, you can do it within a split second. I will show this to you in the live class. Is this clear? Kuldeep sir, did you get this? When the IBP is greater than 65, and I know that there is a strong support at 15,500 out of money, I'm selling the put, buying 15,200 with a strict stop loss of 15,490 or 480. Why I require a strict stop loss? Can you see my risk? Can you see my reward? So if I wait till 15,200, my risk will be a lot bigger. So I have to square off this trade. So now is this clear? When are you going to do bull put spread? IBP greater than 65. Option should be expensive. You are going to sell OTM put. Why? Because there is a support there. You are going to buy far OTM to protect from unlimited losses. Your stop loss is clear. Just below or around this level of 15,500, you will square off. Right? Now, I have made a cheat sheet for all of you all, but I will not share it today. In a bull call spread, what are the Greeks? Delta positive, theta negative, gamma positive. When do you do bull call spread? When money flows with strong momentum, strong volume increase in open interest, breaking important monthly and weekly resistance levels, or taking support at the previous breakout levels. Right? Bull put spread. When I want to do the bull put spread, when IBP is greater than 65, I'm going to sell out of money puts where there is a strong support. Coal India, current price 160, chart showing 155. I sold the 155 put, bought the 150 put. This is to collect theta as an option premium. As the premiums are high with a strict stop loss of the underlying near to the strike price you are selling. Delta positive, theta positive, gamma negative, vega negative. Are both this clear? When are you going to do the bull call spread? When are you going to do the bull put spread? I want Kuldeep sir to prepare this cheat sheet for all of us. Right, Kuldeep sir? You are a hardworking person. Thank you, sir. Now we come down to the very interesting strategy. Bull call ratio back spread. This strategy is deployed when one is extremely bullish in the market and very quick movement is expected in the bullish direction. So you are bullish and very quick movement is expected, right? You are bullish, very quick movement is expected. Now my friends, Bhavna ma'am said, let us take a Bank Nifty example. So my friend Bhavna ma'am is really very bullish in Bank Nifty, right? So what does she do? Minimum 20 to 22 days for expiry. When you are doing a bull call ratio back spread, minimum 20 to 22 days for expiry. So by default, we will take the next expiry. This is 29th of July. So Bhavna ma'am, what does she do? She sells the 35,000 call. She sells a call of a higher premium, one lot. She sells a call higher premium, one lot, and she buys 2 lots of 35,500 call. She buys 2 lots of 35,500 call. Okay, 850, 637. So 637 into 2, how much? How much? Lovely. Let us do this. 35,000 call. 35,500 call. Minus 25 plus 50. So what is the rate? 850. So what is the investment? So let's keep it at 850. So the investment is 850. And what is this investment here? 637. Let's forget the round numbers. So one lot, if I'm buying 850, 2 lots. So basically, when I'm selling, I'm receiving. When I'm buying, I have to pay. So how much am I paying from my house? 1274 plus 850. 424. So just for a safety sake, let us write this as 1275. So the calculation will be easy. Right? 425 rupees I am paying from my house. Is this clear? Are we all on the same page? Good. Now let us see Manasta. What happens? So Bank Nifty 35,000, 34,000, 34,500, 35,000, 35,500, 35,800, 36,000, 36,500, 37,000. So this is the Bank Nifty price for expiry. Now what will happen, my friends? You have, what is the formula in the money? S greater than K. Spot greater than strike. 0. 0. 0. So minus 425 premium paid. Loss is minus 425. Am I clear till here? Good. Now let us go 34,500. What will it be? Bhavna ma'am. 0. Call 0. Only the premium paid. Now 35,000. What will this be? 0. 0. 0. Minus 425. 35,500. What will it be? Rahul sir, will it be 500 plus or 500 minus? You have sold. Lovely, minus 500. Can you see Riamando sir? The loss is 925. Now 35,800. What is it? 35,000 in the money, 800 rupees. $35,500. What is it? 300. Two lots. So 300 into 2 is how much? $36,000. What is it? This one, 500 in the money into 2,000, 1,000. Now here 36,500. How much? $37,000. Thank you, Manas sir. Minus 2,000. Thank you. Plus 3,000. Plus 1,000. Minus 425. 575. So now can you see this? My profit is going up. 37,500. Just see this, because I bought 2 lots. Minus 2,500 plus 4,000 plus 1,500. Can you see my profit is going up? So what is happening? This strike price I have sold. Can you see 35,000? My loss is limited to 425. My maximum loss is the strike where I bought 35,500. After that, my loss is reducing. What is my break-even point? My break-even point is the difference between the 2 strikes. I'll add 500 points. I will add. So 36,000 plus the premium paid. What is the premium paid? 36,000 plus 425. So my break-even point is 36,425. Can you see my loss at 36,000 is 425? So this is my break-even point. Difference between the 2 strikes plus the premium paid, you will add to the second strike. Difference between the two strikes and the premium paid, you will add to the second strike, you will get the break-even point. If I draw a graph, I go with the minus 425 loss till 35,000. My loss goes on increasing till 35,500. And then it goes up. My break-even point is 36,425. And after that, there is an unlimited profit. Now, can you tell me why did I tell you you can't hold this position for more than 4 days? Can you tell me why minimum 20 days to expiry? Why can't we do this in a weekly expiry? Who can tell me why can't we hold more than 4 days and why can't we do in a weekly expiry? Manasda, you have become a champion. See the Greeks. Can you see in the monthly expiry we are losing 11 rupees per day? Why? Because we are buying 2 calls with a lower premium. Theta loss is much higher. Theta loss is much higher. That is why we are taking minimum 20 days to expiry, minimum. So the theta impact neutralizes. That is why we are not doing this in the weekly. Delta positive. Theta negative. Gamma positive, vega positive. See the payout diagram. So, unlimited profit if the market goes up. Can I see my losses are limited? I cannot lose more than the premium paid if the market goes down. But if the market remains in the predefined range, 35,500 to 35,000 to 35,500, this range I will have predefined loss. So what is the difference between a bull call spread and a bull call ratio back spread? Who can tell me? So bull call spread, what was the chart? Like this. And bull ratio back spread, what is the chart? Very good. Unlimited profit. If the market goes up, in this you have limited profit. Limited loss when the market goes down. But here if the market falls very fast, my loss will be minuscule. Why? Because there is a lot of time to expiry. So if the market falls very quickly also, I will be safe. I will get out with a very minor loss. But in this case, I will have a bigger loss. But in case of a ratio back spread, if the market remains in the range where I have made a position, what will happen? Theta will eat away. So what am I expecting? Now, sir, either the market goes up or the market falls in the next 3 to 4 days. Market should not remain there. Good. Rahul sir has given the answer. So where will I make a spread? Bhavna ma'am, Kavita ma'am, when can you make this strategy? Let me take you Bank Nifty. When should you make this strategy, Kavita ma'am? Okay, so I have told my students on days where there are huge gap up, gap down, on days where there are huge gap down, okay, can you see here? And if the market reverses, goes above the day high, or at the end of the day's close, you make a ratio back spread here. Either if the market opens a gap down and goes above the day high, or if it does not, at the end of the day you make a back spread. See, either what happens, market goes up or market will fall. See here again, huge gap down, right? We made here. Can you see in the next 3 days market went up, right? Big, not a small gap up or a gap down. It should be minimum 350 points gap down in Bank Nifty. Minimum 350 points gap down in Bank Nifty. Just see this. Next 3 days the market fell. So even if we had made a ratio back spread in call here, if the market fell very quickly, my loss would have been minuscule. So when there is a big gap down, so I answer the rule is maximum 3 to 4 days, either profit or a loss. You have to square off. See here, next 3 days, market fell. So advantage of this strategy here is if there is a big movement either side, you are very safe. You are very safe. Either the market moves up, see here, gap down, 1, 2, 3, 4. 4 days the market went up. 4 days the market went up. Am I making sense? My friends, all these things nobody will teach you in Google. These theories will not happen. Yeah, these are not intraday strategies. Now, Nifty, Bank Nifty after a gap down is closing at 34,000. What strike will you select? You will buy the 34,500 iron. You will sell the 34,500 iron, sir. Buy the 35,000. Right? Why? Because you are expecting minimum 1,000 points rise in the next 3-4 days. You are expecting a minimum 1,000 points rise in the next 3-4 days after a big gap down. And if the gap down and there is continuous selling, if it goes to 33,000 also, I have no problem. Why? I've showed you my loss is going to be very limited, 50 to 60 points. Manas sir, either side big movement, either side. Either side. If it goes down, my loss will be limited, 10-20 points. And I have to square off after 4 days. I cannot keep this trade for on. I have to square off after 4 days. Am I making sense? So what is it written here? Bull call ratio back spread, minimum 20 days to expiry. Position to be made in a big gap down, not a normal gap down. Right? If it reverses during the day, if no reversal, then at the close of the day. Right? Sell 1 lot of higher premium call, buy 2 lots of lower premium. Maximum holding period is 4 days. What is the maximum holding period? 4 days only. So 20 days by default will be July expiry. Right? Rahul sir is asking the sell call premium greater than buy premium. So sell call premium will always be greater than buy premium, right? Why? Because in the money or a higher premium you are selling. But since you're buying two lots of lower premium, you have to pay money from your house. So supposing if I'm selling something at 500 and I'm buying something at 300, so two lots is 300 into 2. So in the net, I will. So bull call spread problem, ma'am, you can do in the weekly expiry also. If your view is for 24th of June, market is going to go up, you can do the weekly expiry also. But this ratio back spread, always 20 days to expiry. Why? I told you theta. In a bull call spread, your theta is neutralized. Am I making sense? Am I clear? So today's homework, find the big gap downs in Tata Steel and Tata Motors. Big gap down. So Tata Steel about 2%, Tata Motors 3%. And plot that data in the chart. So when you do that, in the live market, we are going to do the back testing of ratio call back spread. Tata Steel and Tata Motors. Am I clear? We will do a back testing. So find out, send the 3-4 dates. So those 3-4 dates, we will do the back testing of the ratio call back spread. Is this clear? So congratulations, friends, you have done all the 3 directional strategies. So if Bhavna ma'am says yes, she means it. Kuldeep bhai, is this clear? So now we are not going to do the bearish strategies this week. We are now going to non-directional strategies. So non-directional, these are the most interesting part. Very interesting. And those people who are professional traders, they use this quite a bit. When one does not know the direction of the market, but when is expecting fast movement, we did the example long straddle, long triangles, or once is expecting a range bound movement, you are employing a short straddle, short triangle, butterfly condor, iron condor, and a calendar spread. So we have already done the short straddle and the short triangle. I told you the disadvantage of a short straddle and a short triangle is unlimited profit, unlimited losses if it goes beyond the break-even points. That is why I said you should not carry those positions. So now if I want to carry these positions overnight and I'm expecting a range, what can I do? So the first one, butterfly. A butterfly is a neutral strategy combining bull calls, spread in calls with 4 contracts of call of 3 different strike price. What am I doing? +1, -2 in the middle, +1. So the first leg I'm buying 1 lot. In the middle strike I'm selling 2 lots. And third one I'm buying 1 lot. So let us do this. Let us check. In Bank Nifty, do you find it a trading range? Do you think that Bank Nifty is in a trading range? Who are the good technical charters? So what is the upper end of the range? 36,000. What is the lower end of the range? 33,500. That is a problem. This is too big a range. Now always remember, non-directional strategies like butterfly, you should first find a range, a narrow movement near to the expiry where you are expecting the markets to close. So in this particular case, I'm not able to predict where the Bank Nifty will go. Why? Because the range has expanded in the last 10 days from 36,000 to 33,800. There is a bigger movement. So I cannot trade this. So let me go check Nifty. Yes, Nifty I can. If you see, Nifty at 15,600 and 15,800. Can you see this? Can you see Nifty 15,600 and 15,800? Can you see this is a range? Can we say this? So, Rahul sir, what am I doing? I'm expecting Nifty to close between 15,700 and 750. Right? What am I expecting? In a range, Nifty is there through the help of the charts. I have drawn the range. And in the range, what can I see? Between 15,000. Bhavna ma'am, I think so you're not in the class. You just come right now. 15,600 to 15,800 is the range. Right? So what I'm thinking, that market should close in this expiry between 15,600 and 15,800. This is my calculation. I'm expecting the narrow range for this expiry. So what am I going to do? I'm going to buy one strike for 15,500. Right? Sorry. 15,600 was my expectation. Sorry. So I'll buy a 15,550 call. I'm selling 15,700. Two calls. I have bought one call of 15,550. I'm selling two calls of 15,700. And I'm buying one call of 15,850. So what have I done? I bought one call of 15,550. I've sold two calls of 15,700. I bought one call of 15,850. Right? So what have I done? If you see carefully, +1, -1. What is this? I bought one call, sold one call. What is this? Bull call spread. You remember? Now I'm doing -1, +1. I'm buying one bull call spread, selling another strike. Spread. So when I'm buying 15,550 to 15,700, it is like this. Bull call spread, you remember the chart? Now when I'm selling the 15,500 call, 15,700 call and buying the 15,850 call is just like this. So see the first 15,550, 15,700. Now when I'm selling this 15,700, buying 15,850, this is the third leg. So this is the total leg of the butterfly. Now in this, what is the advantage? Can you tell me what is the advantage seen here? Can you see the max profit? Can you see the max loss? Loss is very small compared to the profit. Can you see the trading range? Not bad at all. For 4 days, if I'm getting a 250 point range and the market stays in this range, if market takes a support tomorrow at 15,550 and goes up, it is a good trade. What is the other advantage? See the margin. Only 50,000. Am I making sense? When are you going to do the butterfly? When you are near to the expiry, number 1. 5 days near to the expiry, number 1. Point number 2. You know that the market is going to close around 15,700 to 750. So which area you are expecting to close, you will sell the middle strike. The distance between strike 1 and strike 2 is 150 points. Should be the same between strike 2 and strike 3. So directional strategy, no. You are expecting a range, Kavita ma'am. You are not bullish. You are expecting Nifty to stay between 15,600 and 15,800. This is your break-even point. So if Nifty stays here on Thursday, you will make very good money. So if you see the Greeks, delta, neutral, theta, positive. So if the market remains there, you will make money. Gamma, negative. Vega, negative. So if there is a big announcement, what will happen? Butterfly will lose money. If there is a big announcement, butterfly will lose money. Why? Because Vega is negative. If the market goes up or goes down in a big way, your gamma will affect your delta. So as long as the market remains in this range, you will use this strategy. So when will you exit this strategy, Kavita ma'am? If Nifty closes below 15,500, then you know that now this range is broken. Or Nifty closes or goes above 15,880. Upper boundary and the lower boundary. So if till Nifty remains in your boundary, you can hold the trade. If Nifty goes beyond the boundary lines, this trade is not valid. Then you will have to exit. You can hold this trade. Limited loss, limited profit. But is this making sense? Is this clear? Bhavna ma'am, this trade is to be taken near to the expiry. Near to the expiry. Either weekly or monthly, maximum 4 to 5 days. Why? Because if it is more than 4 to 5 days, what will happen? Can you predict? You cannot predict. Right? You cannot predict. So that is why you take near to the expiry. So now let us put an Excel. Let us put this data into Excel and let us see what are the break-even points. Absolutely, Meena ma'am, best strategy, weekly expiry. Best strategy. When you are near to the expiry, butterfly works very well. So today I hope you guys are not getting bored. You guys are not tired. You guys are enjoying today. $213, $112.46. Right? So I bought this first leg, bought the third leg, sold the second one. So what is my net premium from my house? Only 35 rupees. Now let us see 15,400, 15,500, 15,600, 15,700, 15,800 and 16,000. So what will happen, my friends, if Nifty closes 15,500, 15,400, what will happen? 0, 0, 0, 0, minus 35, minus 35. Am I clear? What was the formula? Spot greater than strike, S greater than K. Right? Is this clear? I will share this sheet again. Why? Because these examples need to be shared. 15,500, 0, 0, 0, 0, minus 35, minus 35. 15,600, in the money, what will it be? Plus 100. Can you see this is 0, 0, 15,700, what will this be? $15,800. Yes, Kuldeep sir, will this be 300? Will this be minus 100? Will this be 0? Is this correct? Is this correct? Thank you, Ayan sir. Thank you. I've sold 2 lots. Minus 200. $16,500. This is minus 300 into 2, 600 plus. Sorry, I have taken the wrong strikes. This will be 15,550. Sorry. Let me check. Yes, I've taken the right example, 15,550. Sorry, I've taken the wrong example. So this will be 50 rupees, 0050, 15 plus 50 plus 50 plus 115, right? Plus 250 minus 200 right? 0, 50, 35, 15. So now this is 450 minus 600 plus 150, 0, minus 35, 0, minus 35. So can you see this? My loss does not exceed till the premium paid. So there are two break-even points. The first strike plus the premium, 15,550 plus the premium 35. So 15,585. And the last strike minus the premium. Can you see this? There are two break-even points. 15,850 minus 35, 15,815 and 15,565. 585. So these are your two break-even points. And if I draw this from 15,535 rupees, maximum profit is at 15,700. Again, your PL comes down. It is something like this. Like a butterfly. Can you see? These are the wings. Limited loss to be done in a range-bound market near to the expiry where you expect the range to be. Am I clear? How many are you from Maharashtra? Nilesh bhai, vada pav. The middle one double vada. First pav, last pav. Near to the expiry, Rahul sir, 5-6 days near to the expiry. So you can make this if you feel Nifty is going to be in this range. You can make this expiry. There is a 35% to 40% probability Nifty might close here. 40%. Right. Now the question comes, Rahul sir has asked me twice, is this clear with the call? Please click a photograph. Please click this photograph and send it in the WhatsApp group. Have you done that? Please click this photograph and send in the WhatsApp group. Done? Good. Now, the same strikes we are going to use as put. Instead of call, I'm using the strikes as put. I'm buying the 15,850 put, selling the 15,700 put, two lots, buying the 15,500 put, one lot. Can I see the PL? Is it similar? Technically, it should be the same. Technically, it should be the same, but due to some bid and ask difference, can I see the Greek same? Delta, neutral, theta, positive, gamma, negative, vega, negative. So whether I make a butterfly with a call or a put, the result is the same. Just see this. Whether I make a butterfly with a call or a put, if I'm using the same strikes, the result is the same. Always remember the difference between the first strike and the second strike. And the second strike and the third strike should be same. Leg 1 and leg 2. Leg 2 and leg 3. So Kavita ma'am, if you're making a 200 points difference, let's make a 200 points difference. Let us take this at 15,500. 200 points. Let us keep this as 15,900. So can you see this? 15,500 and 700, 200, 700 and 900, 200. What will be the break-even point? Last strike and the first strike. So the total premium paid here is 67. Right? So the first strike put minus 67. Last strike plus 67. So 15,833. 15,500 is the last strike plus 67. So 15,567. So this is your butterfly, same range. Am I making sense? Yeah, 10, 15 points. This might be because of the liquidity. It should be the same, right? So what are the rules for butterfly? Near to the expiry, around 4 to 5 days, you should know that this is where you are expecting Nifty to close. You will sell 2 strikes around your level of expectation. Third point, no Rahul sir, either you will do a butterfly all with calls or all with puts. No call and put, different strikes. Either all call, all put. Am I clear? Good. So this is near to the expiry, expecting range bound movement. And the longer you can hold till the expiry. When will you exit? When you feel now the range is broken. In the market is not going to come back to that range. You will square off the butterfly. Good. Now we come down to a version of butterfly. It is called a condor. Please see, limited risk, non-directional strategy. Same thing like butterfly. My risk was limited to the premium paid. Non-directional strategy, which gives limited profit even when the security is perceived to have limited volatility or a range. No, this is a condor, not an iron condor. So what is the condor? +1. You can square up any time, any position. +1. -1. -1. +1. So what is the difference? Butterfly was vada pav, +1. -2. This was the vada. And +1 was the pav. So this is how I remember a butterfly, vada pav. So condor, +1, -1, -1, +1. This is a McDonald's burger. Cheese in the middle and cutlet in the middle. Margins are all very low. Very low margins. Let us do a condor. Same thing. Same example. We feel. Let us make. So we are buying the 15,550 call. We are selling the 15,650 call. Now we are selling the 15,700 call and we are buying the 15,800 call. What have we done? We have bought one call 15,550. We have sold one 15,650. So distance between strike 1 and strike 2, 100 points. Same distance between strike 3 and strike 4, 100 points. Now can you see, my friends, what is your maximum loss? 1729. What is your maximum profit? 5771. So when are you going to make this profit? If Nifty remains from 15,650 to 15,700. Can you see here? So if Nifty maintains here between the second strike and the third strike, can you see 650 and 700? In between these two strikes, if Nifty remains till this area, you will make maximum profit. So what is the difference between a butterfly and a condor? A butterfly is something like this. Flat top, only single point of maximum profit. Condor has a wider base of profit. Between the second and the third strike, you have the maximum profits. Now the Greeks will remain the same like that of the butterfly. Delta neutral, theta positive, gamma negative, vega negative. Same principle, near to the expiry. Only difference here, in a butterfly, your maximum profit is in a single point. In a condor, your range expands. So now, my friend Ayanda says, no sir, I'm expecting the markets to remain little more bullish. So Ayan sir feels market is going to be a little more bullish. So what does Ayan sir do? He buys the 15,600 call. He sells the 15,700, 750 call. He sells the 15,800 call. And he buys the 15,950 call. Why we have taken these higher strikes? Because Ayan sir feels that the market range is much more bullish, right? Market range is much more bullish. 48,000 margin, same. Can you see now my maximum loss has gone up? Why? Because I've expanded the range. So if you expand the range, can you see the range is now 250 points? My maximum profit is between 15,750 to 15,800. Decent. It becomes slightly bullish. If you see the delta, it will just slightly be positive. Slight positive, nothing major. Theta majorly, gamma negative, vega negative. So let us do this example in Excel. So did you understand? On the basis of your calculation, you can create this range. So your understanding of the market is very important. If you get the directional movement wrong, you can be wrong. So you have to exit also. Kuldeep sir, I'm sending you. You are going to do this. I'll be sending the sheet to you. Right? So just do the labeling and send it back to me. Yeah, that's understood. So what is my net investment? First and fourth strike I bought 46 rupees. And second and third I've sold. So this is McDonald's burger. So 15,400, 15,500, 15,600, 15,700, 15,800, 15,950. 15,900 and 16,000. Right? Right. So what will happen? All are zero. All are out of money. Right? So no money received. What is it? Premium loss. Same year. No money received. Premium loss. 15,600. Add the money. Premium loss. Now come here. Yeah, what will it be? 15,700. What will it be? 100 rupees. Lovely, Rahul sir. This will be 0, 0, 0 plus 100 minus 46 plus 54. Now let me keep this as 15,750. So what is it going to be? 100 or 150? 150, lovely. 0, 0, 0 plus 150 minus 46, right? Now let us keep this as 15,800 plus 200. What will this be? Minus 50, 0, 0. Now let us keep this at 15,950. What is this? 350. What is this? 250. 200. 150. 0. 0 minus 46. Minus 46. So can you see this condor? My maximum loss is 46. So what is my break-even point? First strike plus 46. So 15,646. Last strike minus 46. 15,940 minus 46. Can you see my break-even points? Is this clear? Range bound market. Near to the expiry. Always understand, I answer. Butterfly and condor, you cannot predict what is going to happen. So the expiry is 24th of June. Right? I answer you can do Friday, you can do even on Monday. Tuesday morning also you can do. So supposing the expiry is on 24th, you can do on 19th, 21st, 22nd. There is no problem. Near to the expiry. Am I making sense? Yeah, whenever you make a strategy, You will always enter together. You will always exit together. Whenever you make a strategy, you will always enter together and exit together. So I respect the feeling of Ayan sir saying that he is getting confused. So we will do revision rather than taking up a new subject. Right? We will do revision rather than taking up a new subject or a new strategy. The reason is Ayan sir is getting confused. Right? Kavita ma'am, you have not revised, so better revise today. Okay? So let us start with what was the first one we did? Nifty bull call spread. Why did you do a bull call spread? Who will answer this? Why did you do a bull call spread? Who will tell? You are bullish in the market. You are expecting the markets to go up with a fixed stop loss of Nifty. Might be 15,500 or 15,460. You are buying in the market. So what are you doing? You are buying the call of a higher premium. We are selling a call of a lower premium. In the expectation that Nifty will go close at 15,900 or above. With the expectation that Nifty is going to close 15,900 or above. Limited loss, limited profit. Right? Bull put spread. You're bullish in the markets. Right? You're bullish in the market. Instead of a call, you are selling a put with a higher premium. Net credit. Buying a put of a lower premium. So if I'm using the same strike as a bull call spread, in the bull put spread, my PL will also be the same. My PL will also be the same. So when did I tell you to use this strategy? When did I tell you to use the strategy? I have told you to use the strategy when IVP is greater than 65. What are you going to do? Out of money put. You will sell and you will buy far out of money put. You will sell out of money put. Nifty has a support of 15,500. You are selling the 15,500 put. 15,700 put. 15,300 put you are buying with a fixed stop loss of the underlying. Am I making sense? How many of you have gone through this Excel? How many of you? Has anyone gone through it? What is an Excel? No one? So all the strategies which I have taught you, bull call spread, bull put spread, bull call ratio back spread. So these three strategies are the mirror opposite. Butterfly call, put butterfly, condor. All the strategies which I have taught you today are there. Right? Am I making sense? Now we come down to the ratio call back spread. These are all directional. What do you mean by directional? I am bullish in the market. And I am doing a bull call spread. I am bullish in the market. I am doing a bull put spread. I am very bullish in the market.
3-4 days, I'm expecting a big up move. I'm doing a bull call ratio back spread. -1 +2. Right? -1 +2. Unlimited profit if the market goes up. Limited loss if the market remains in the range. Sorry, limited loss if the market goes down. And predefined loss if the market remains in the middle of the range. Right? Predefined loss if the market remains in the middle of the range. So let's do it once more quickly so that we are all in the absolutely in the same page. Bull call spread. So how do I remember the bull call spread? How do I remember? I'll just tell you. +1 -1. +1 higher premium call. -1 lower premium. So when I draw this, it is something like this. This is the first leg. This is the second leg. This till here loss, till here profit. Limited loss, limited profit. Is this clear? Bull call spread. When I'm bullish. Bull put spread. When will I do that? Net credit. When I'm selling and receiving a higher premium. It is called a credit strategy. -1 +1. -1 higher premium +1 lower premium. Right? So when I'm selling a put, higher premium like this. When I'm buying a put, it is like this. So in the net, what is it? It will become like this. Same way, like a bull call spread. So this will be the net change. So this is something like this. It will go here. So when the market goes up, I make money. When the market falls, my loss is limited. So I've given you the chart. -1 +1. Now ratio back spread. -1 higher premium +2 lower premium. Unlimited profit if the market goes up. Limited profit if the market goes down. Predefined loss if the market remains in the range. Predefined loss if the market remains. So when did I tell you to do this? When you are either expecting a big fall or a big rise. But if the market remains there, nothing can be done. 20 days to expiry. Big gap down. Big gap down. If the market goes above the day high during the day, sustains, I'll make there, or at the end of the day. Or at the end of the day on the closing if the market is bearish. Am I clear? Now we come down to the next one. Butterfly. Non-directional. What do you mean by non-directional? Range bound. Near to the expiry. I'm expecting this trading range. So I'm buying one call, selling two in the middle, buying the third one. So the distance between the first and the second leg, and the second and the third leg should be the same. Right? The distance between the first and second and third should be the same. Okay, that is a butterfly. So it is something like this. Bull call, and you're selling a call and buying a lower premium call. Like this. So you're expecting the market to be in this range. Right? So it should be done near to the expiry. Why? because you're setting two strikes in the middle, so you will get the theta advantage. So near to the expiry, you get the big theta advantage. Okay? And you get the last one. Either you do with the call or the put, impact same. And the last one is a condor. +1, -1. -1, +1. Am I making sense? Variation. So if I'm doing a condor, this is strike A, this is strike B, this is strike C, and this is strike D. A, B, C, D. Range bound, near to the expiry, where you're expecting the range. So the middle strikes, you're eating the theta, the first and the last one. So your goal should be, it should close between strike B and strike C. So now you have two strategies remaining, iron condor and calendar spreads. We have completed most of it. So we are near to our completion of the strategies. So the next class, first half, we will be completing all the strategies. So how is the Josh, my friends? Always remember, in a directional strategy, when the market goes against your stop loss level, you will exit. In a butterfly or a condor, if the market goes outside your range, you will exit. In a bull call spread, you made a bull call spread, and if Nifty breaches 15,450, you need to exit. Yes, Kavita ma'am, your revision is not up to the mark. You need to improve. I can see precision in Rahul sir's revision. I can see precision in Ayan sir's revision. They have precisely revised. Mukesh sir precisely revised. There are others also who are precisely revised. They are absolutely with the class. Rahul sir precisely revised. Srinivas, Satish sir precisely revised. I can tell from Ria Mando sir, he has given full time yesterday and today. Ria Mando sir, how long did you revise? How long? He has given minimum 3 hours to 4 hours. I'm sorry, sir, I had to give you some medicines. I can tell you, sir, as a teacher, I can tell you, your body language, if I could have seen you, I would have understood the positivity. But I can still feel it. I can anticipate it. I answer, short straddle, Bank Nifty, what I've taught you, keep doing. It will help you to improve your psychology about trading and life. Right? So I saw a number of you all yesterday in the webinar. Answer, were you there? Yes, Kavita ma'am, I saw you. Okay. I saw Mukesh bhai, I saw Kuldeep bhai. Number of you were there. I answered, I saw you. That is why I asked you. I saw your name. So how did you get the entry? Someone would have sent you the link, right? Good. Mukesh bhai, you can ask me questions off mic today if you have any. Just send me a WhatsApp message. You can ask me. Ina ma'am, take care. Good, Riamando sir. Good. You are right there near the top. I think so. Little bit of practice, Yamando sir, with experience, you will make it. Yeah, Meena ma'am, entries of Sat. If you're making a butterfly, one by one, you make an entry into all four and you exit all four. In Condor also the same thing, all the four. So strategy means all together, all exit all together. That is the meaning of the word strategy. Everything, you enter one strike, sell one strike, exit also both of them within a matter of seconds. The first step towards change is awareness. The second step is acceptance. Learn to be aware if you have a problem. Second step, accept that you have a problem so that you can improve upon that. Right? You don't need to close. Automatically the stop loss will close your position. I answer. Automatically the stop loss will close. Right? Why do you need to close positions? Other leg you don't need to close. 325. Close of the day. Meena ma'am, that's our job. So as trader, that's my job. The mistakes which I made, I don't want you all to make. So that is why I'm coming out with the strategies. That's why I'm discussing this chart to make you understand where to enter, where to exit. Yeah, you will keep it open, I answer. Good. Yes, ma'am. Wonderful. Good to see you trading, Meena ma'am. I really like your attitude. Keep it up. Without getting into the water, you cannot learn swimming. Without trading in the markets, you cannot learn about trading. Right? That's my belief. Thank you all for your time, for your effort. Gunjan sir, you are very quiet today. Jiblanti ma'am, all very quiet. Ketki ma'am, very quiet. How is it going? Everyone? Good, Ketki ma'am, nice. So today in the deepness of the strategies, I forgot you. So my due apologies to all of you who have forgotten. So when you do strategies, you want to share so many things. So you miss out. So good, I expect full revision from all of y'all. Thank you. Thank you all. See you Saturday with full revision so that we can make a blast. We can make the most out of it. Bye-bye. Take care.